This is the Kevin Simpson Show, expert insight and analysis from the industry's top investment professionals. If you'd like a deeper understanding of today's markets, this is the show for you.
Welcome to this episode of the Kevin Simpson Show. My guest today is an old friend, Mark Luschini. Mark is the Chief Investment Strategist for Janney Montgomery Scott, or Janney. He is also the President and Chief Investment Officer of Janney Capital Management. He's coming to us from the beautiful city of Pittsburgh, and I realize that you're claiming it's not raining behind that window, and we'll take your word for it. But with Kevin and Mark is my illustrious co-host who's going to be steering the ship today, Jay Coulter. Jay, as always, thank you so much for being here.
Absolutely. Mark, thank you so much for joining us. I'm going to go ahead and get started. Mark, I read a recent piece that you put out entitled, "The U.S. Withdrawal from Afghanistan is Relevant for the Markets?" with a question mark. Recently, Kevin had Jackie DeAngelis on the show, and here's what she had to say on that topic, and I want to get your take.
Well, obviously, the first thing I would say before we even get to the metals and the minerals would be the stability in the region. Again, having lived there and understanding the players and the dynamics, obviously Iran is one of the big bad actors. It's got all of its proxies in different countries sort of wreaking havoc to a certain extent. I mean, that's their goal, is not to have stability. That's the way that regime continues to stay in power. So the linchpins that you have, the American allies, for example, the UAE and Saudi Arabia, all wonderful, but don't necessarily marshal the same kind of power. And so when you're seeing what's happening in Afghanistan with the Taliban right now, it concerns me greatly because I think about overall stability in the region.
So we recorded that last month. Your piece seemed to align with her thinking about other actors in the area creating problems going forward. What's transpired in the last 3 or 4 weeks that may or may not have changed your opinion?
Well, really, nothing has, Jay. Again, listening to Jackie's remarks, concur that it isn't so much what was taking place on the ground, the human tragedy associated with it, and so forth in Afghanistan per se. But rather the spillover to the region at large, because I think there's still something here that is in the offing, perhaps in weeks or months. And that, of course, is we, as of yet, do not have a conclusive agreement with any kind of détente with Iran. And as they continue to move towards the nuclearization of their country, which by some accounts, it could be as soon as 2 months to perhaps 10 weeks. That could lead to some type of conflict that has all kinds of consequences, not only in terms of a military involvement, but as well a potential spike in oil prices, depending upon how they approach it, whether it's via a direct or a proxy attack on oil fields in Saudi Arabia, clogging up the Strait of Hormuz, through which about 20% of the world's oil supply travels on a daily basis, whatever it might be. That could lead to, obviously, something that could inflict pain on oil-consuming countries, others including the United States, India, even China to a degree, and therefore would have, obviously, an immediate impact on the economy, particularly when we're in the throes of concerns around inflation and whether it's abating or how sticky it's likely to be, and the more influential impact on those, the lower income cohort, that do most of the spending in this country and ultimately are the cohort most logically responsible for driving our economy.
Well, Kevin and I definitely want to get to your opinion on inflation. You have some great content in the marketplace on that. But first, and I think this is germane, you were quoted in Market Watch about 2 weeks ago, and I want to read this because I want to get it right. "We could go through the better part of 2022 with abundant cash. That would keep the market-based rates tamer than they might otherwise be and positions equity as the asset class of choice." And you also went on to add that high quality and high dividend corporate bonds and being a little bit careful about treasuries at this time. So that was a couple of weeks ago. A, have your thoughts around that changed? And B, what are the implications for financial advisors that have to allocate to fixed income when they're building portfolios?
Well, certainly, Jay, on the latter part, that's been a challenge that is certainly not new. It's one we faced for the better part of the last decade, of course. And there, the delicacy of the issue is What do you do with either duration, benchmark matching, exceeding, or shorter thereof relative to the amount of interest rate sensitivity you have in your portfolio? And then secondly, within the fixed income market, what kind of instruments are you going to use to provide for opportunity for whatever your view might be relative to establishing a highly interest rate sensitive position in treasuries because you feel interest rates are going to remain level or work lower, or conversely, some type of inflation protected securities, or those that may suffer an adjustment that would be less severe than that of direct treasuries. And of course, our view is that we're likely to see interest rates move up, even begrudgingly so, but move up over the course of this year and into next as a consequence of still fertile conditions for the U.S. economy to continue to prosper. We acknowledge that we're probably in a deceleration phase of economic growth from the first half of this year in the aftermath of the immediate stimulus that was applied to the economy, both fiscally and monetarily, in the second half of last year. But having said that, we still think that there's room for treasury yields to rise further. And as a consequence of that, want to brace for that in the fixed income allocations clients in some cases have or should have to fend off the volatility that is normally associated with equity prices, although we haven't seen much of that in the last 12 to 18 months. But do so in a way that positions for an anticipatory outcome that we believe is likely to look like something where interest rates do move higher. There is some prospect for inflation that continues to operate at or above the Fed's targeted level of 2%, and therefore want to look at those areas of the fixed income market that offer some relative value. I mean, arguably, there isn't a tremendous amount of value to be found at all in the fixed income market. It's really relative to other securities within the fixed income market that I named, areas like in the credit sensitive corporate space, whether it's investment grade or even in high yield, for those who have the risk budget to tolerate it. Dividend paying equities are obviously another alternative. A different risk budget is needed to allow for what allocation one is committing to that. But nonetheless, for yield, for the prospects of seeing that yield increase as dividends are increased by the companies that are paying them. And then secondly, for participation in the equity market that has risen a lot over the last 18 months, but we think there's further to go. That to us, relative to fixed income, remains the asset class of choice.
Well, Mark, in addition to inflation, we're definitely going to get to dividend-paying stocks. But I'd love to know, before we move on from treasuries, in your framework, how high do you see rates going before the end of the cycle? And when I say rates, let's talk about the 10-year specifically, because that's the easiest for advisors to model.
Agreed. That's the bellwether. We certainly don't expect to see yields on the 10-year north of 2% in the near future. However, we see the migration that we've seen of recent in yields that could lead to a print on the 10-year at around the 1.45 or so level, back into the channel that it had occupied for a considerable period of time, even as yields were working lower from the spike high in March of this year of 1.77 on the 10-year Treasury. Ultimately, we think, though, that we can get back to at or around those levels, that kind of 170 to 180 level before the end of the year, which doesn't sound like that large of a move from today's mid 130s on the 10-year Treasury, but in a security with such a low yield and a duration over that 10-year, probably on the order of 7 or 8 years, it suggests that investors today that would be a purchaser of that 10-year Treasury in a move that saw even a 50 basis point increase in yields would suffer considerable paper losses on that security if they were to be sold at that point in time. So that's why we're taking a very measured approach to why investors want to, if you will, find alternatives to Treasury securities in portfolio, particularly longer duration ones like the 10-year bond.
Kevin, when you look at the 10-year through the capital wealth planning framework, where do you see the 10-year unfolding through the rest of the cycle?
Yeah, I mean, if we get to 2% over the course of the next 18 months, that seems like an amazing stretch from where we are today. And when you listen to Mark talk about those numbers, 1.7, 1.3, even getting back to 1.45 by the end of the year. I mean, if we were from another planet, it's almost laughable what we're talking about, to have such an embarrassingly low yield. It's basically zero, no matter how we cut it. And how high is that compared to what you get overseas in Europe with the negative yield on the German 10-year bund? So, sometimes I shake my head at the conversations that we have, because really what we're making is an argument that you can't be in fixed income for a return. To Mark's point, you've got to be in fixed income to allocate your portfolio as a buffer, as a preparation for things to come, but you can't expect to make any money there, especially if you factor inflation against it. And it sounds like we're probably on the same page when we get to an inflationary comment as well, but it's sometimes I wake up every morning happy I'm not a fixed income portfolio manager. Let me just say it that way.
Oh, that's a great transition to inflation. So, Mark, in preparing for this interview, Kevin and I found a piece that you put out on August 20th that's still germane today, a month later. So in the piece entitled "Preserve Purchasing Power to Weaken Inflation's Impact," you noted, quote, "We found that some investments withstand inflationary periods. For example, commodities, real estate investment trusts, and stocks." Let's talk about the pros and cons of each one of those, starting with commodities. What do you see, Mark?
Well, commodities have been an asset class that have gone through a fairly sizable period of time in which they've been very poor performers. Remember, we have to go back to early 2000s through about the end of the first decade of the new century, 2010, 2011, when they were the best performing asset class by far. And remember, though, that was coincident to a time in which China entered the World Trade Organization and grew from a $2 trillion to $10 trillion economy. And then along the way, during that period of time, gobbled up 50% or more of everything that came out of the ground. And so as a consequence of that, not only did emerging markets and their countries' exports to China flourish, many of which are resource driven, but secondly, commodity prices in general moved up considerably higher. And so after a decade plus of malinvestment, ultimately on the part of preparing for this consumption pace to continue on in perpetuity, we found that the growth rate and the appetite thereof for those commodities began to plateau and ultimately roll over to still a very fast pace. And China continues to consume more than 50% of everything that comes out of the ground, but less so than it did before. And so a consequence of that is that commodity prices suffer as there was overcapacity that had to be right-sized to the level of consumption of commodities that we were experiencing over the last 10 years. I think we're near that level. If you look at something like the Commodity Research Bureau, CRB, Commodity Index, you can see that we're approaching levels last seen back more than 10 years ago in the price charts. And I think it's indicative of the prospect that while we may not be necessarily ready to declare there's a new commodity super cycle, I think we may be in the early innings of a transition from a period in which it had suffered considerably to one that it begins to mark time as perhaps a potentially better asset class performance-wise. We've already seen that over the last year, and maybe even one of the better performing asset classes in the decade to come. So in general, that's a way to hedge for the prospects of inflation too, because inflation also has a deleterious effect on our currency, the US dollar. And typically the dollar falls as inflation rises, and that also helps to boost the value of commodity prices, as most are priced in US dollars. So I think it's again, a multi-supported area of the marketplace to consider an allocation to, perhaps not in size at this moment, but for some of your portfolio to be able to not only participate in the overall growth of stocks just in general, because they are listed securities, but also the leverage that they provide in terms of mining companies to participate in the spot price movement of the underlying commodities that they're lifting out of the ground.
All right. So the commodity case for inflation, it's been around for a while. It's really hard to invest in for a lot of advisors. It sounds like you recommend looking at the actual equity securities as opposed to a futures-based product. Is my assessment of your comments correct?
I think one can look at it either way. I think one can participate in the individual equities, the miners themselves, and not just those that are domestic, but global in nature. But in addition to that, obviously with the proliferation of instruments like ETPs, exchange traded products, whether it's an ETF or an ETN, you can also get more direct exposure for somebody who's looking to be a little bit more surgical and how they strike the commodity complex. You can go into an ETF that represents broadly the commodity index, like the Bloomberg Commodity all commodity index, BCOM, BCOM, that is, via symbol DJP. Or conversely, you can actually own, obviously, things like copper or other lithium, other commodities directly through ETFs that represent specifically the spot price movement, or at least proxy to the spot price movement of those particular metals.
So, Jay, we bought Newmont Mining on Friday, small position, Mark, maybe 4%. But kind of thinking along your same thesis that there's opportunities there that incredibly underperformed. And at least with respect to Newmont Mining, we're getting a 3.5% dividend. So if we're continued in the range-bound trade, we're getting pretty nice compensation on the dividend yield. I was reminded when you were talking, it was 2011. It was around this time. And Josh Smith, my lead PM, and I were thinking the markets were subject to a little bit downward pressure. So we said, all right, you know what? We're going to go in and we're going to buy GDX and GLD. Markets are going to go down. We're going to hedge it. We're going to be hedged, and this is going to work out great. Of course, we were right to the extent that the markets went down in the fourth quarter of 2011, but our awesome hedge went down worse than the S&P 500. So I'm hoping that here we are 10 years later. History is not going to repeat itself with the Newmont Mining buy on Friday, but I'm comforted by your comments that maybe it wasn't a bad idea. Also, maybe great minds thinking alike.
Absolutely.
All right, so we've covered commodities as a potential inflation hedge, and Mark, in that note, you'd also put out REITs as a great hedge. What's the thesis there on how investors are protected potentially against inflation with a REIT?
Well, real estate investment trusts, obviously got slayed in the midst of the pandemic as worries about the shedding of employment and workers that were occupying commercial, retail spaces, et cetera, would lead to, carnage across the industry. And largely that has proved to be true. However, you look at the performance of REITs after the initial decline, they've performed quite well. In fact, so far this year, at least 2021, that is, they're one of the best performing sectors of the market, albeit a small sector, 2.6% or so of the S&P 500. Having said that, I think the opportunity there is that obviously landlords are looking for opportunities to repurpose portions of the space that were once occupied by employees who are now working remotely or moved to different locations. And then secondly, obviously landlords also had the ability to raise rents over time. And while they were reluctant to do that when they were worried about fleeing tenants, we're starting to see a resumption of obviously return to work, new businesses that are reopening, and some that have stayed that have continued to hire. And either way, you have, I think, a fundamental support for real estate investment trusts to be able to take what they have today in terms of their occupancy rates and build on them going forward. Number one, since in many cases they're hardly full, but then two, obviously through the contracts that they write over different period terms, they can also raise rental rates over time as they are in a better position to have the leverage to go back to their tenants and tell them that next year their premium is going to look like X plus as opposed to the X we gave you to incentivize you to move into our space a year before. So that's a way that they have historically acted as a fairly defensive sector against the prospects of inflation that typically is accompanied by rising prices from everything from food and other products, but also to rental increases.
I tell you, Mark, I have some clients looking for real estate in Atlanta, and they're seeing 4%, 5%, and 6% escalators written into their contracts, to your point. Kevin, at Capital Wealth Planning, do you guys use REITs as any type of inflation hedge mechanism inside of your strategies?
Jay, when we built the strategy, there were 10 sectors in the S&P 500. So our portfolio is going to include those traditional 10 sectors. We have the ability to add real estate into it, but it's not a requirement. So we have had some positions in REITs over the past 3 years. The most recent, we were getting involved with some cell tower REITs, which worked out so well, they got called away. We had written a covered call against it, and that gave us a nice profit and a nice income for a while. But to Mark's point, when you've got something that's a true inflationary hedge, which is the ability to raise rent, it's a solid investment. We believe in it. And just like you're saying in Atlanta, I'm sure in Pittsburgh and Naples, Florida, there's very few things that are as valuable as real estate in Naples. Maybe Bitcoin, I don't know where it's ending up, Jay, but I don't understand that, but I do understand real estate.
Oh gosh. So Mark, your piece talked about commodities, which we've covered, REITs, and then equities, stocks as a hedge against inflation. What's the thesis there?
Well, the thesis, generally speaking, and it's somewhat idiosyncratic to the sector. Some sectors have proven to be much better at being able to pass along price increases than others, given the fact that some have more inelastic products and some have more commoditized products. But in general, what companies have the ability to do is raise prices and hold to those price increases if the state of the economy and the state of their customers, whatever they represent, can withstand those price increases and absorb them, if you will. So we're prone to think that stocks in general, because of the current economic backdrop, certainly are in a position to be able to raise prices given the state of the consumer, which we believe in general is quite healthy. The consumer is very well endowed at the moment as a consequence of, for many, keeping their employment conditions status quo throughout the pandemic, and for others through various fiscal supports over the last year and a half or so, and the prospects of filling some of the 10 million plus jobs that are open today, that the consumers that are just re-engaging back to the labor market are likely to be very friendly to consumption patterns as we build on the gains already made here economically and within the stock market. But in general, once again, it's companies' ability to raise prices, to take the input costs that they're incurring that are moving higher and pass those along to consumers to the extent possible as a mechanism, if you will, for allowing their margins to remain relatively intact and fend off the prospects of an erosion of their profitability that might otherwise come were they not capable of passing along those higher input costs and therefore having their profitability impaired as a consequence. And in general, stocks have been able to do that, quite favorably to their benefit, and that's why, in general, once again speaking, aggregating all 11 GICS sectors today, they tend to fend off the ravages of inflation better than fixed income securities. There comes a point, historically speaking, above 3%, particularly in that 3 to 4 and higher percent rate of inflation range, when stocks do begin to suffer in the aggregate. Market multiples begin to compress as investors begin to discount the prospects of margin contraction and impairment to profitability that will reduce the valuations that are being afforded to stock prices. Right now, we're running at an inflation rate that arguably on headline is above that level. At the same time, though, as evidenced by a couple of other securities that one can look at it as in the fixed income market as a tell on what market participants think about inflation. Most investors have seemingly bought into what the Fed has been selling in terms of current inflation levels are transitory in nature and are likely to recede back to at or maybe even slightly above their targeted rate of average inflation around that 2% level.
Well, Jay, what Mark said is really important because even at 3%, the best companies that can control their pricing, that can control their supply lines, that have pricing power, real moat companies, you can still do very, very well in the stock market. We don't need zero inflation for these great companies to do well. You can have inflation and still make great money in the stock market. What I think neither of us want to see, any of us want to see, are higher interest rates. That's when the party starts to, maybe wind down a little bit.
Agreed.
And Kevin, what's your take on stocks as a hedge against inflation, specifically in a portfolio?
No, I mean, Mark just echoed everything perfectly. You can't say it any better than that. But the point is, you need to have best of breed. Again, control your supply line, control your pricing. You need good, solid, strong balance sheets to get through tough times. But there's been 2 periods of 10 years where we've seen the stock markets do very little. But had you been invested in these great companies, that dividend becomes such an important component within your performance that I just feel like all 3 of those issues, maybe real estate and equities before commodities, because I'm also worried I jinx myself with this new mining trade. But I really feel like you can't look anywhere else. And that doesn't mean just close your eyes and buy meme stocks or anything weird. You need real companies with real valuations. And it's not easy picking stocks. But for me, there is no other place to be.
So, Mark, I've been working with Kevin for just over a year now on these shows. And one thing I've learned about him is that when he's not doing these shows, he's either on CNBC or he's talking to advisors 12 hours a day. And I have to imagine in your role, as I read that you oversee about $124 billion as of last June. So I'm sure it's up since then. You have conversations with advisors every day, and they express their concerns, what they're looking at from a portfolio construction perspective. What do you think the advisors are missing today?
Well, I think they focus on one variable, like valuation. That's often a pushback on why the stock market can continue to go higher from here. Looking at a multiple on trailing earnings of, say, 25 times for the S&P 500, and perhaps even on forward earnings of 20 or 21 times. And so they focus on that, and that causes consternation in terms of being a willing buyer, to a willingness, if you will, to commit new capital to the stock market for fear that valuation doesn't support the opportunity for stock prices to move higher. And so, my, if you will, reply to that, to debate why valuation in and of itself is a poor measure of making a judgment about future opportunities, is that one, it has very low predictive value over the short term, meaning a year or more. Where it has very high predictive value, historically speaking, is over a 7 to 10 year time horizon. So we can extrapolate from high valuations the likely returns that might be generated over a 7 to 10 year period hence, and therefore can make judgments about the prospects of borrowing from perhaps returns that could be generated in the near future. Means we're likely to see lower than historic returns from the stock market being produced over the next decade or more. But that doesn't mean between now and then we can't see stock prices continue higher, even much higher from where we are today. And that's predicated upon perspective, to contextualize what that 20 multiple means to the stock market. One, in the context of a 1.3 or 4% 10-year treasury yield. And obviously that feeds the TINA principle. There is no alternative. And of course, two, is the fact that you have to look at it in the context of the earnings yield of the stock market. And the earnings yield of the stock market minus the yield on fixed income securities, almost regardless of which one you use, gives you an equity risk premium. It's what investors are asking to be compensated for the risk of owning a historically volatile asset class like stocks versus other things, namely, call it in traditional asset class world, bonds and or cash. And right now, that equity risk premium is still quite elevated by historical standards, and it frankly is even more attractive for investors that are willing to venture into overseas markets, particularly in areas like Europe, which happens to be a land that occupies companies that are among some of our favorites today. But the point is that is contextualizing it. The second thing is looking at multiples in a historic basis and realizing that it's only in the last 30 or 40 years that the composition of the S&P 500 has changed dramatically, where it's dominated by these, asset-rich, capital-light companies that are growth stocks, as we often kind of lump them into a style category, that really demand, if not even warrant, a much higher multiple than that which would be given to the classic cyclical sectors like energy or industrials or basic materials stocks. And the composition has changed rather severely, such that perhaps what was likely the old norm of saying the market should trade around 16 times trailing and 14 times forward, while true back in the 50s and 60s and even parts of the 70s, is perhaps less true in an environment when you have technology representing 27, 28% of the S&P 500, and collectively financials, industrials, materials, and energy don't even represent, I think, close to 20% of the S&P 500. And so one has to think about it in those terms as well. And that's not an argument necessarily that says that, buy tech at any cost, but it just, I think, helps to, if you will, satisfy those concerns that today's market, if only looked at in the prism of what was historically and also without any context with regard to looking around at alternative investments, leads one to conclude that I want to be a wary buyer of the stock market for it's overdue for a correction. It's ripe for a pullback of some order of magnitude, and I'm going to stay sidelined until that occurs. And what we've seen, of course, over the last 15 months is we haven't had a correction even so much as 5%. So that investor looking to buy the dip either had little opportunity because it was so shallow, or two, it was so fleeting, they missed the opportunity to even think about what it was that they wanted to buy in the midst of one, that they missed the opportunity. And here's a market that's basically doubled off the March 2020 lows. And as I said in some of my earlier comments, I think has further upside.
So, Kevin, based on the calls that you're having with advisors today, what do you think they're missing?
First of all, Mark is on every time I turn on any TV channel. He's on every publication that I ever open. He works 20 hours a day. The whole concept of valuations are the same thing. You know, clients are always worried about Murphy's Law. How do we get in? And I had to get my head around it 30 years ago because I kept saying, I wish I would have been alive 30 years prior to this business. And my mentor taught me a lot of, really good lessons. Was like, you're an idiot. What makes a stock price go up? I said, well, if they earn more money. He says, great, go find companies that increase their earnings. I'll bet you their stock prices go up. Good things happen to stocks that make new highs. And I was like, yeah, good things happen to stock that makes new highs. So to Mark's point, you don't look at the index. You don't look at valuations per se across every single thing because technology stocks have a different valuation, a different multiple. We own Dow, the old-fashioned Dow Chemical Company. I think the PE is like 11, but it pays a 4.5% dividend. It's the same concept of maybe this entry point isn't perfect for the broad markets, but there's always things to invest in. And you never have to put everything in at one fell swoop because Murphy's, if he's not right behind me during this whole video, he's over there somewhere because Murphy's Law just happens to just follow me around like crazy. So what's a better solution? Layer in, layer in, layer in. And if we get a pullback, great, put more money to work. I was thinking, we bought Caterpillar because it was off 14% from its highs. Chevron off 14% from its highs. Two stocks we don't own, but just for comparative purposes. Zoom Video, big, popular tech name, off 25% from its highs. Win, great reopening trade. We don't own it, but it's a wonderful company, 34% off of its highs. So even though the market may not have had a broad correction since last October, those are four stocks that have. They're just the first four I could think of.
So, Mark, let's wrap up with a quick discussion about your equity income strategy. And as novices to the strategy, we'd love for you to explain it to us, frankly, like we're financial advisors. What are the design features, the allocations, and what would an advisor experience with the equity income strategy?
Well, Jay, our equity income strategy was started back in 2004, and really it was spawned by a similar environment as we have today. Alan Greenspan had lowered interest rates to zero in anticipation of Y2K. And so investors were starved for income, which obviously has remained the case over the better part of the last 15 plus years. So we thought what we could do was take some companies that we were near and dear to by way of owning them in other strategies that also happen to offer a high dividend yield and build out a portfolio strategy to address those needs, those concerns that were being expressed to us by clients of our firm's financial advisors. They were looking for income. Not at any cost, but income. And what we thought about in the design concept was it wasn't just about income today. It was also about the company's ability to increase that income stream over time. So what we built was a portfolio, typically 40 to 45 names in size, broadly diversified across most, if not all, sectors of the economy, globally positioned, which was unique. We've typically held 30 to 36, 37% of the portfolio in international equities, mostly because they offered a more attractive yield than their US-based counterparts, but also had that same propensity to be able to sustain their dividend payout almost regardless of economic conditions and or raise it with some consistency. We weren't necessarily declaring that we were only going to own the aristocrats, but we might want to consider what we own as nobles, if you will, which is to say maybe some companies stopped paying dividends in the midst of the great financial crisis, but restarted. Or we know that in some cases, particularly in Europe, companies basically tithe, if you will, their dividend payout structure to their profitability. So as profits fluctuate, they can raise or lower their dividends so they're not impairing their corporate capabilities by way of over-consuming cash or having to take debt on to pay out a dividend that they're committed to. And so we allow for some flexibility around that, but ultimately we also decided to target a yield even though it's a globally diversified portfolio, to be 2 times that of the S&P 500 index yield, which today is roughly 1.3%. Our portfolio is paying out a little north of 3% as a yield. And over the last 1, 3, and 5 years, that dividend has increased by, in the aggregate, the companies that comprise the portfolio raising their dividend over the last year by about 6%, and the last 3 and 5 years by about 9%. So it's not only starting with a relatively high yield that's being manufactured by companies that we think have fortress balance sheets and have the wherewithal to prosper in the economic climate, regardless of whether we're in an expansionary modality or recession. And as well to be able to pay out a handsome dividend structure, and again across the portfolio in the aggregate, see that income being raised with some level of consistency that allows our clients who were investors to see their payouts increase over time, particularly those which in many cases are drawing on that income stream to subsidize themselves in retirement or otherwise, and see their income basically, in essence, giving them a raise, allowing them to maintain that purchasing power parity that's chewed up or eaten away by the ravages of inflation.
What is the ballpark allocation to domestic versus international?
Right now, we're about, if you will, 64% domestic, 36% international. That tends to fluctuate a little bit with maybe a band of 5% or less on either side of that. It's not something that we necessarily mandate to, but typically we found if we're looking at a US-based company that has an international counterpart that's basically in the same business but offers a more attractive yield and similar otherwise characteristics in our prospects, we're going to go for yield and opportunity for growth in profitability and income, and not necessarily let borders bind our decision-making process.
And is this strategy available as an SMA mutual fund or ETF?
It is available only in an SMA format with a minimum account size of $100,000.
Jay, I met Mark about 5 or 6 years ago when Janney opened an office in Naples, Florida. Memory serves, Mark, it was probably January or February that you came down from Pittsburgh. I don't know if that was coincidence or not, but I got the opportunity to listen to Mark speak, and I was just thought the portfolio was a perfect complement to everything we do. And over the past few years, we're working with so many advisors at Janney, and they're using Mark's product, and they're partnering with either our SMA or our ETF because it's a perfect blend of taking advantage of dividends, dividend growth. He has 45 names. We have 30. It's got a heavy emphasis, maybe not heavy, but we have 0 international. So you get some really good compliments there. We also write covered calls. So we might forfeit a little bit of the upside. So over the past 3 or 4 years, the advisors that have been pairing our strategies together have been just really raving about it. And I thought, what a great opportunity to bring Mark on the show, talk about Janney, talk about the strategies. And I know how successful he's been as a portfolio manager, and we're just thrilled that you could join us today. And anything we can do together in the future, it'll be a great partnership. I want to say one other thing that Mark said during that presentation I thought was really smart. I like to be around smart people. Not the smartest guy in the room, but I try to keep smart people around me. And we were talking about international investing, and it is not my forte at all. But you were specifically talking about China, and at the end of brilliant, eloquent discussion of what was happening in the Chinese economy, only about maybe 1/10 of it I understood. You said, and their GDP is going to be slowing to 7 or 9%. And I thought, 7 or 9%, that seems like a really strong GDP. And you were like, but they can say anything they want, because who knows what their GDP really is? It could be negative and they'll say it's 7%. And how completely prognosticating a comment that was, as we look at what's happened to China over the past 2 or 3 years. So as you were talking earlier, I was remembering that comment, and I thought, boy, that was such a neat thing, and it stuck with me at the time, and it's even more relevant today than it was 6 years ago.
Yeah, I'm glad for the occasion for us to have met back then, and it might have been pure coincidence that I was down there when we were sitting on probably 2 feet of snow and some kind of sub-zero temperature here in Pittsburgh. But nonetheless, I welcome the opportunity to be in Naples for all seasons.
Mark, thanks so much for coming on the show. We really enjoyed the conversation.
Thank you, Jay. Appreciate it. I did the same.